This is a small business success visual blog prepared for students who are learning how to create their own business. What does that look like? How do you describe a successful business owner? What do you need to know to be successful? Well, we're going to take it bit by bit. Colin Powell said that there is no secret to success. It is the result of preparation, hard work, and learning from failure. You are on a journey that will be hard work for you and ultimately your support team, but you are preparing now to minimize the failures and ensure long-term success. It will not prevent an occasional failure, but you will know that success comes to those who stand back up and proceed. There are business basics that are foundational and important to understand even if you don't apply to your current situation. Your circumstances may change, and it is good to know, or at least have an awareness of the situation. I will examine the pros and cons for various business methods. These are not the business structures like sole proprietor corporation, not-for-profit, LLC, but they are important methods of operation that warrant a closer look. Generally, new business owners take one of the following forms: a new venture creation, purchasing an existing business, franchising or buddying, family business, or employee to ownership. From inheriting a business from a family member to starting your own online stores, there are pros and cons to examine and determine what feels good to you and how does it fit with your mission and vision. Family-owned businesses account for 90% of all businesses in the United States, large and small. The day-to-day job of a family business owner can easily be complicated by relatives who need to work together to arrive at profitable business decisions. A family business is an easy way to enter into the business and often provides support in multiple facets of the business. The downside is that the business is too easy to start and the timing may be off. Family members know each other too well. However, they are the people you know and trust. Success is real when the family members are very clear about the mission and vision of the company. Decisions must be objective and not based on emotions or personal preference. Communication must be clear and established prior to difficult situations. Establish a clear line of authority for decision making. Make sure that everyone is aware of the process for making decisions and who is responsible for what. Include everyone in the process with the authority to manage their responsibilities is helpful and provides everyone with direction, especially if they have their own job descriptions. Dealing with differences of opinion or performance issues may be challenging at best. In a family business, key players are more willing to discuss how they feel and argue about issues and changes to the business. It's very challenging to remain objective about the situation. The ultimate success of the business is decided based on the passions of the members and their desire to be in business. Often the continued success is based on a well-crafted contract agreement signed by all parties. The contract agreement applies if you are planning on a partnership or a family business. A contract, even among family members, is a good first step because it clears away many of the obstacles and issues that haunt a family when under stress. The list here is not all-inclusive, and there are other things that you will want to add. Follow your attorney's recommendation and put in writing those things that will cause heartburn. Who owns what percentage? And how are the profits and the losses divided? What happens when a partner dies? Who is going to make the everyday decisions? The contract goes for a family business and for the all too common partnership. entrepreneurs, buying an existing business represents less of a risk than starting a new business from scratch. While the opportunity may be less risky in some respects, you must perform due diligence to ensure that you are fully aware of the terms of the purchase. So the advantages of choosing an existing business include that the lead time to get up and going may in fact be shorter, plus the past records that you will have data that you can review before making decisions. It is helpful that the customer base and the suppliers are already established. If you decide to buy an existing business, you'll want to make sure you are making the right choice in your new venture. Only you can determine the right business for your needs. There are many favorable aspects in buying an existing business, such as the drastic reduction in startup costs. You may be able to jumpstart your cash flow immediately because of existing inventory and receivables. There are disadvantages. There are downsides to starting your own business or purchasing a business. The purchasing price may be much higher than the cost of starting a new business because of the initial business concept and perceived value of the current owner. The customer base, brand, and other fundamental work has already been done. Also, be aware of hidden problems associated with the business, like debts the business is owed that you may not be able to collect. You need to do your due diligence. As you become a business owner, there are items that need to be addressed before you enter into a business agreement or transaction. You must look at all license and permits, zoning requirements, environmental concern. You must determine the value of the business by one of several different methods. Important is to discover before too late the reason for the sale of the business. So do your research. Once you find a business that you want to buy, conduct a thorough and objective investigation. Look for letters of intent, confidentiality agreements, contracts, leases, financial statements, tax returns. Sales agreements, checklists include adjusted purchase price, review required documents, signing promissory notes, patents, trademarks, copyrights, franchise, closing settlements, covenants not to compete. Buying an existing business can be very advantageous unless you do it sight unseen and didn't look under the hood. You need to be an eagle-beagle detective to ferret out all the facts. Even then, there may be something hidden away that will come back to bite you later. Franchising or buddying. Owning a franchise allows you to go into business for yourself, but not by yourself. The advantages. A franchise provides franchisees with a certain level of independence where they can operate their business. It provides an established product or service which may already enjoy widespread brand name recognition. This gives the franchisee the benefits of a pre-sold customer base, which ordinarily would take years to establish. A franchising increases your chance of business success because you're selling a proven product and a method. Offer consumers the attraction of a certain level of quality and consistency that is mandated by the franchise agreement. Franchises offer important pre-opening support, including site selection, design, construction, financing, training, and grand opening programs. Franchises offer ongoing support, training, national, regional advertising, operating procedures, and operational assistance, ongoing supervision, and management support, increased spending power, and access to bulk purchasing. But there are disadvantages. The franchise is not completely independent. Franchisees are required to operate their business according to the procedures and restrictions set forth by the franchisor in the franchisee agreement. These restrictions usually include the product or service which can be offered, pricing in geographic territories, and for some people, This is the most serious disadvantage to becoming a franchisee. In addition to the initial franchisee fee, franchises must pay ongoing royalty and advertising fees. Franchisee must be careful to balance the restrictions and support provided by the franchisor with their own ability to manage their business. A damaged system-wide image can result if other franchisees are performing poorly or if the franchisor runs into unforeseen problems. The term or the duration of a franchisee agreement is usually limited, and the franchisee may have little or no say about the terms of termination. Home-based businesses. For more and more people, home is not only where the family is, but is where the business is. During the past 3 years, large numbers of people have chosen to market their skills and talent from home. Recent studies estimate that as many as 20% of new small business enterprises are operated out of the home, and the trend is growing. Many small business, home-based businesses are started as a part-time basis and then expand to full-time business as the market for the business develops and grows. The majority of home-based businesses are started by women and typically employ other family members. Types of home-based businesses range from service-oriented childcare businesses to product-oriented craft outlets. Other examples include farming, catering, specialty mail order, home horticulture, computer software, woodworking, and bed and breakfast establishments. People are attracted to home businesses for many different reasons. They include experiencing the personal satisfaction of making their own decision, expressing their own idea, and being their own boss. Those starting small home-based businesses come from many different groups such as homemakers, single parents, youth, dislocated workers, hobbyists, and people interested in adding to their income. Operating a home business can give you a sense of independence and personal satisfaction. However, to be successful, you will need to make strong commitments to the business and its needs. Being your own boss does not give you total independence. Meeting the various business needs, such as customers, suppliers, employees, will limit your independence. Operating a home-based business usually requires a greater commitment of time, energy, and money than most jobs. It also requires a great deal of sacrifice, making it difficult to balance the business and family needs. So advantages of operating a home business include you can start as a part-time business with more flexible lifestyle and more integrated into the family. It has lower startup and operating costs, cost savings on child and adult care, no commuting, flexible work hours, satisfaction of being your own boss, increased tax benefits and write-offs, employment of family members by the business. But there are disadvantages as well. Space may be cramped. There may be limited growth potential and family use. Personal and family lifestyle patterns may be disrupted. Business and family privacy may be disrupted. Long work hours and time away from the family. Lack of fringe benefits. Lack of informal and social contact or opportunity to network. Stress due to challenges when balancing family and business needs. Family members and friends may demand more of you when you're home all day. Business activities may cause problems with neighbors. Discipline is required to establish steady home work patterns. So take time to establish an atmosphere of open communication within the family to help generate trust and support, which will help you grow your business. Sole proprietorship. It is the simplest and most common structure chosen to start a business. It is an unincorporated business owned and run by one individual with no distinction between the business and the owner. You are entitled to all profits and are responsible for all of your business debts, losses, and liabilities. It is the structure with the most risks. You do not have to take any formal action to form a sole proprietorship, as long as you are the only owner and act under your own name. This status automatically comes from your business activities. In fact, you may already own one without even knowing it. If you are a freelance writer, for example, you are a sole proprietor. If you make masks and sell them to neighbors, you are a sole proprietor. If you sell makeup or baskets, you are a sole proprietor. If you choose to operate under a name different from your own, you will most likely have to file for a fictitious name, also known as an assumed name, trade name, or DBA name, short for doing business as. You must choose an original name. It cannot already be claimed by another business. There are advantages of sole proprietorships, besides being easy and inexpensive to form, because the costs are minimal and the legal costs limited to obtaining the necessary license or permits. Because you are the sole owner of the business, you have complete control over all decisions. You aren't required to consult with anyone when you need to make a decision or want to make changes. Your business is not taxed separately, so it is easy to fulfill the tax reporting requirement of a sole proprietorship. The tax rates are also the lowest of the business structures. But there are disadvantages. Because there is no legal separation between you and your business, you can be held personally liable for the debts and obligations of the business. This risk extends to any liability incurred as a result of employee actions. Insurance is the best protection from lawsuit of any kind. Sole proprietors often face challenges when trying to raise money because you can't sell stock in the business. Investors often won't invest. Banks are also hesitant to lend to a sole proprietorship because of a perceived lack of credibility when it comes to repayment if the business fails. The flip side of complete control is the burden pressure it can impose. You alone are ultimately responsible for the success or failure of your business. Partnership is a single business where two or more people share ownership. Each partner contributes to all aspects of the business, including money, property, labor, or skill. In return, each partner shares in the profit and the loss of the business. Because partnerships entail more than one person in the decision-making process, it's important to discuss a wide variety of issues up front and develop a legal partnership agreement. This agreement should document how future business decisions will be made, including how the partners will divide profits, resolve disputes, change ownership, being a new partner or buying out current partners, how to dissolve the partnership. Although partnership agreements are not legally required, they are strongly recommended, and it is considered extremely risky to operate without one. General partnerships assume that profits, liability, and management duties are divided equally among the partners. If you opt for an unequal distribution, the percentage assigned to each partner must be documented in the partnership agreement. There are advantages. Partnerships are generally an inexpensive and easy-formed business structure. The majority of time spent starting a business partnership often focuses on developing that partnership agreement. There's a shared financial commitment in a partnership. Each partner is equally invested in the success of the business. Partnerships have the advantage of pooling resources to obtain capital. This could be beneficial in terms of securing credit or by simply doubling your seed money. A good partnership should reap the benefits of being able to utilize the strengths, resources, and expertise of each partner. Having an employment advantage, partnerships have an employment advantage over other entities if they offer employees the opportunity to become a partner. Partnership incentives often attract highly motivated and qualified employees. But there are disadvantages. Similar to sole proprietorship, partnerships retain full shared liability among the owners. Partners are not only liable for their own action, but also for the business debts and decisions made by other partners. In addition, personal assets of all partners can be used to satisfy the partnership debt. With multiple partners, there are bound to be disagreements, and partners should consult each other on all decisions, making compromises and resolve disputes as amicably as possible. Because partnerships are jointly owned, each partner must share the success and profits of their business with the other partner. An unequal contribution of time, effort, or resources can cause discord among the partners. A corporation, sometimes referred to as a C corporation, is an independent legal entity owned by shareholders. This means that the corporation itself, not the shareholders that own it, is held legally liable for the actions and debts the business incurs. C corporations are more complex than any other business structure because they tend to have costly administrative fees and complex tax and legal requirements. Because of these issues, corporations are generally suggested for established, larger companies with multiple employees. A corporation may sell stock, which are certificates indicating ownership, to as many people as desirable. Among the advantages of corporation formation are limited liability of the shareholders and the ease of transferring ownership. If the name of the business includes the word corporation, Inc., incorporated, or corp., then the business must be incorporated. A corporation is formed under the law of a state in which it is registered. Once your business is registered, you must obtain business licenses and permits. So the advantages of the corporation is limited liability. When it comes to taking responsibility for business debt and action of a corporation, shareholders' personal assets are protected. Shareholders are generally only to be held accountable for their investment in stock in the company. Corporations have an advantage when it comes to raising capital for their business in the ability to raise the fund through sales of stock, but also to obtain funding from banks and other organizations. Corporations file taxes separately from their owners. Owners of a corporation may pay taxes on corporate profit paid to them in the form of salaries, bonuses, and dividends, while any additional profits are awarded a corporate tax rate, which is usually lower than a personal income tax rate. Corporations generally are able to attract and hire high quality and motivated employees because they are often competitive, have competitive benefits and potential for partial ownership through stock options. But there are disadvantages. Corporations, like LLCs, are costly and time-consuming ventures to start and operate. Incorporating requires startup, operating, and tax costs that most structures do not require. There's also double taxation. In some cases, corporations are taxed twice. First, when the company makes a profit, and then again when dividends are paid to shareholders. There's additional paperwork. Because corporations are highly regulated by federal, state, and in some cases local agencies, there's increased paperwork and record-keeping burdens associated with this entity. An S corporation, sometimes referred to as an S corp, is a special type of corporation created through an IRS tax election. An eligible domestic corporation can avoid double taxation once to the corporation and again to the shareholders by electing to be treated as an S corporation. To be considered an S corp, you must first charter a business as a corporation in the state where it is headquarters. What makes the S corp different from a traditional corporation or C corp is that the profit and losses can pass through to the individual owner's tax return. Consequently, the business is not taxed itself. Only the shareholders are taxed. There is an important caveat, however. Any shareholder who works for the company must pay him or herself reasonable compensation Basically, the shareholder must be paid fair market value, or the IRS might reclassify any additional corporate earnings as wages. Many S corps are only one-person companies that the individual acts as the president, secretary, treasurer, and owner of the 100% of common stock. There can only be 100 shareholders. They can only have one class of stock. Certain financial institutions, insurance companies, and domestic international sales companies cannot be an S corp. And in order to become an S corp, the corporation must file Form 2553, election by a small business corporation, signed by all shareholders. All states do not tax S corps equally. Most recognize them similarly to the federal government and tax the shareholders accordingly. There are advantages of an S corp. One of the best features of the S corp is the tax savings that you and your business, while members of an LLC are subject to employment tax on the entire net income of the company. Only the wages of the S corp shareholder, who is an employee, are subject to employment tax. The remaining income is paid to the owner as a distribution, which is taxed at a lower rate, if at all. Some expenses that the shareholder or employees incur can be written off as business expenses. An S corp designation also allows a business to have an independent life separate from its shareholders. But there are disadvantages. As a separate structure, S corps require scheduled director and shareholder meetings, minutes from those meetings, adoption and updates to bylaws, stock transfer, and record maintenance. Shareholder compensation requirements. The shareholders must receive reasonable compensation for their work for the company. A limited liability company is a hybrid type of legal structure that provides the limited liability features of a corporation and the tax efficiencies and operational flexibility of a partnership. The owners of an LLC are referred to as members. Depending on the state, the members can consist of a single individual, one owner, two or more individuals, corporations, or other LLCs. This is not a corporation, although it is often confused as one and sometimes treated as one by the IRS. The IRS states limited liability company, or LLC, is an entity formed under state and foreign law by filing articles of organization as an LLC. Unlike a partnership, none of the members of an LLC are personally liable for its debt. Unlike shareholders in a corporation, LLCs are not taxed as a separate business entity. Instead, all profits and loss are passed through the business to each member of the LLC. The LLC members report profits and losses of their personal federal tax returns, just like the owners of a partnership would. The LLC is well suited for every type of business venture except banking and insurance, which are prohibited by statute. Examples of acceptable businesses are farming, construction, manufacturing, all types of real estate ventures, personal and business services, accounting, architecture, and other professions, just to name a few. There are advantages. Members are protected from personal liability for business decisions or actions of the LLC. This means that if the LLC incurs debt or is sued, members' personal assets are usually exempt. There are fewer restrictions on profit sharing within an LLC, as members distribute profits as they see fit. Members might contribute different proportions of capital and sweat equity. Consequently, it's up to the members themselves to decide who has earned what percentage of the profit and loss, and which should be defined as a contract between the partners. Of course, there are disadvantages. In many states, the business is dissolved and the members must fulfill all remaining legal and business obligations to close the business. The remaining members can decide if they want to start a new LLC or part ways. However, you can include provisions in your operating agreement to prolong the life of the LLC if a member decides to leave the business. Depending on the state, there are other types of legal structures, including co-ops and non-for-profit entities. I'm going to quickly touch on two legal concepts that are vital to all small businesses, regardless of their organizational structure: contracts and intellectual property. First, contracts. Agreements between groups or individuals. Small business owners need a wide variety of contracts to start and stay in business, from leasing to supplies and equipment maintenance to buy and sell agreements. An attorney can prepare contracts, or often we can download simple contracts from internet sites. I wrote my own version of a contract, then sent it to an attorney to review. We often repeated that process until we were both happy with the document. Anytime you shake your hands with a representative from another business about any aspect of the business, it should be after a document is signed. Because I worked as a contractor for the SBDC, I wrote a contract that the training I created legally belonged to the Vision Tree LLC. The director of the SBDC signed the agreement, so I retained the rights to use the training anywhere I wanted. On the other hand, the training I created to certify small business advisors was owned by the state of Illinois SBDC, and I do not have the right to sell it. I had several organizations who wanted to use my online training, but the Illinois was very selective in who they allowed to use the code. While I made money on the sale of the source code, it was split with the Illinois SBDC, who did nothing except own the copyright to the original data and in-person training. Intellectual property. There are several forms of protection under the law of the governmental agencies. Copyright. Anything that is written, published, or otherwise original, such as poetry, movies, books, online training. Although the first time one of my training modules went to the Library of Congress to receive a copyright, they didn't have a classification for the training, and it took extra effort and time to submit the first module. Getting a copyright is cheap, easily done online. If you wrote it, protect it. A woman came to me for help. Her teenage son had written a beautiful poem while he was dying from an autoimmune disease. After his death, she asked a friend to put one of the poems to music to play at this funeral. Later, she heard the song on the radio. Although the song was making considerable money for the musician, when she approached him, she was unable to receive any compensation because she hadn't paid $30 to copyright the song. An attorney is not required to copyright. Patent costs are much more than $30 and much longer to complete. Inventions or a procedure that is unique and never documented prior to this data submission. It is more likely to cost $30,000, and it is not customary for the inventors to do the legal work required, and a special lawyer is normally hired to complete the work. Trademark. A trademark or service mark is a logo that may also include words used in a unique way and used to brand an individual organization. Trademarks can be issued by the state, national, or international. A U.S. patent registration will not protect your trademark in a foreign country. Trademarks are territorial and must be filed in each country where the protection is sought. To file a specific country, check the WIPO's list of international trademark offices. I own the trademark Small Business Spoken Here from my online training. I owned one for Market Drafters for web design and web hosting, but I am letting that one expire because I no longer develop websites as a business. The state trademark, service mark, and the trade name are usually cheaper than the national version and very often much easier to obtain. Regardless, when in doubt, protect yourself. An organization is supported by pillars strategically placed to sustain the organization's values, vision, mission, and purpose. The Small Business Success Series puts a focus on all pillars that support your organization.